So we're going to be talking about Intro to Sales Forecasting. Sales forecasting is going to be a major part of this class. So what is sales forecasting? According to Business Dictionary, it is a projection of achievable sales revenue based on historical sales data, analysis of market surveys and trends, and salesperson's estimates. Essentially, revenue affects practically every aspect of business. A sales forecast is going to demonstrate the feasibility or success of your business idea or concept. Sales forecasting will give you a specific target to reach for each month or even for several years. You'll see many sales forecasts that go on for 3, 5, 10, and even 20 years out as a means of estimating in a very educated way that is based on research what sales are going to be or what goals are going to be for sales. Within sales forecasts, you will include your revenue, including revenue streams and sales mixes, your cost of goods sold, your labor cost, your fixed expenses, variable expenses, startup expenses, and then your overall income projections. So basically your conclusion of all of your findings. Let's start with revenue. When considering revenue, you want to look at it from a research perspective from the very beginning. So once you've decided what your business concept is, you want to look at your competition. You want to do research. You want to figure out what sales will look like on busy days, slow days, average days. How much is the average customer spending? So what would they be willing to spend? You also want to consider normal sales fluctuations. So depending on what type of business you're running, there will be times of year that are extremely busy. So Christmas. There also may be times of year that are very slow. If you own, let's say, a clothing store on the beach, you're going to be making tons of money during the summer, and then sales are going to plummet in September, October, November, and then increase for your holiday sales, and then decrease for January and February until you hit spring break again. And so these are all things you need to consider. What times of year are going to be expensive? What days of the week are going to bring in lots of money for us? Now, do research. As I mentioned previously, check out your competition. Don't just make up these numbers. Look up numbers for your competitors. Look up their average sales for each of the above questions that we talked about. Talk to people in the industry. They'll have a lot of insight for you. A lot of times even business owners will be willing to hash out some averages. They're not going to give you their exact revenue numbers, but they'll give you a ballpark so you kind of know what you're dealing with. So you want to look at your revenue sources. What products or services will you be offering? The variety of products or services a business sells is called a sales mix. Now, sales mix is usually categories, and within those categories, there's going to be different items. So each revenue source item of your sales mix will provide you with a different cost associated with it. So I know that sounds really confusing, so let's look at the next slide. Here are 3 examples of sales mixes from 3 different industries. So you have clothing, you have a restaurant, and you have an auto shop. You want to look at the different categories, which are going to be your sales mix, and then within those categories are going to be items. So for example, at the sales mix for the restaurants, you've got your dine-in food, your beverages, your catering, your carry-out, and your special events. Within dining, you have different plates. So you've got salads, you've got pastas, you have steaks. Within beverages, you have alcoholic beverages, you have sodas, water, coffee. And so you can see that there's different items in each one. It's important to know what your cost is associated with each of those individual items because it helps you to be more efficient in the future. It's also important to know which one of your sales mix categories is going to cost more or be cheaper. So for example, dine-in food sales are for the most part be more expensive than your catering. With catering, you can offer discounts because you know exactly how many people and you can buy in bigger bulk. Whereas in dine-in food, you never know how many people are going to come into your restaurant, so there may be waste. You're also going to charge more for steak and lobster than you would for, say, a salad. And so looking at all of these different items helps you to plan better for the future so that you can become more efficient in your expenses versus your revenues. Having this knowledge allows you to decide what menu items to keep on your menu or to maybe remove. All of this allows you to make better decisions, healthier decisions for the growth of your business and its revenues and cutting down or cutting back on costs. The cost of your item in association with how much it's sold for is your cost of goods sold. Basically, this is shown as a percentage of sales. As we talked about, each item will have a different cost of goods sold because each item comes with different expenses. You can find this number by taking the amount you paid for an item and dividing it by what you sold it for and then multiplying it by 100. So for example, if you paid $10 for a dress and sold it for $30, the formula would be 10 divided by 30 multiplied by 100, which equals 33.33%. This works if you are a retailer or buying something wholesale and reselling it. If you are manufacturing, you need to add in your direct labor costs as well as any additional materials you need to manufacture your items. Once you have that total, then you divide them by what the item sold for and multiply it by 100 to get your cost of goods sold percentage. The reason this percentage is so important is it gives us a quick insight into areas that we could be improving in order to get our revenues up and our expenses down, particularly when associated with our goods that we're selling or manufacturing. So it lets us look quickly at areas that may need improvement. The idea is to get your cost of goods sold percentage as low as possible. Next is going to be your labor costs. So in most industries, labor is your largest expense, and a lot of people are surprised to find that. In order to find your labor costs, you're going to have to go back to the research that you did when you were considering revenues of how many people did you think you were going to be in and what times of year were going to be busier. And so now you have to look at that research and you have to consider how many people or how many staff members do I need to cover those types of sales. And so now you want to make yourself a mock schedule for each of the different scenarios that you came up with. You want to come up with, for very busy days, average days, and slow days, or potentially slow times of the day or seasons. And so you want to come up with a couple of mock schedules, and that way you know how many people you need for how many hours a day, and then how much are you planning to pay them. So basically it would be how many people times the hours you need them multiplied by what you're planning to pay them. Once you have that number, you want to add around 8% to account for taxes, vacation pay, sick pay, so payroll expenses or expenses associated with having a team. Okay, now we can calculate our gross profit. So your gross profit is your revenue less your cost of goods sold and labor. So for example, if you sold $30,000 this month, your cost of goods sold was 33% or $9,900. Your labor cost for 7 employees working 30 hours a week at $12 an hour would equal $10,080. Then you add 8% for payroll expenses, and that comes out to $10,886. Your formula for gross profit would look like this: $30,000 less $9,900 plus $10,886. This gives you a total gross profit of $9,214. If we're looking for the gross profit margin, this is going to be a percentage. So that formula would be 9,214 divided by our original revenue or sales this month times 100. This would give us a gross profit margin of 30.71%. The reason why gross profit margin is important is because it shows whether or not your sales are sufficient to cover your costs. So it's a quick way to make sure that you're earning enough money to keep your business operational. Now we want to look at our expenses. There are several different types of expenses. We're going to start with what is called fixed expenses. Fixed expenses are a type of expense that does not change with your sales. So these will always be the same. So for example, your rent is always going to be the same. Your insurance is not going to change with your sales. Your internet and phone is going to be standard. And usually salaried employees are going to get a monthly base pay. Variable expenses are expenses that remain flexible or potentially change. So variable expenses are going to be your labor. So just like we talked about different times of day, different seasons, you're going to have more or less labor depending on what sales are like. You're going to need to purchase more materials based off of sales, so it's going to increase and decrease. Your utilities, you may have your store operating more hours in the summer and less in the winter, and so utilities are going to fluctuate. Credit processing fees. So generally, credit processing fees are based off a percentage of your sales. So if you have really high sales, you're going to have higher credit processing fees. If you have lower sales, you're going to have really low credit processing fees. Generally, shipping is going to increase as sales increase. So these are all variable expenses. Next, you want to get a hold on what your startup costs might be. Startup costs are going to vary depending on what type of business or what your needs are, but here are some ideas. You want to think about what do you need to get your doors open. So if you are going to open a storefront, is it already built or do you need to build the inside? If you need to do an entire build out, you're going to need engineering, you're going to need an architecture, you'll have to pay the city for permits and deposits. So these are all capital improvement costs where these are going to stay with the building. Even if your building is already built and ready to go, you'll still need equipment to get your business running and furniture and fixtures, right? You'll need decor. On top of that, you'll need funds for hiring and training. This is something a lot of people forget about. There are costs associated with finding the right employees and making sure that they are trained well enough to start your business. So you're spending money before you're even earning a dime in this situation. So what are your startup costs? Okay, so now it's time to take all of the research that we did and compile it into one table. What we're looking at here is an example of a 3-month projection. I'm going to use an example that is a seasonal business. So here at MiraCosta, we're very close to the beach, so summer is going to be a very busy season for us. And so you can see in the month of August, our sales are going to be the highest, and then they'll slowly decrease as we hit September and October. Once we have our sales portion figured out and what our projected sales are going to be, we then need to subtract all of our costs. So we'll start with labor. In the first month of August, we have labor of $5,760. But as sales decrease, our need for that many employees, or potentially having that many employees working so many hours, is going to decrease. Maybe our store isn't open for as long. Fall days are much shorter. You'll then want to subtract your fixed expenses. So you'll notice these fixed expenses don't change. They're staying the same. So this is items like our rent and our business insurance. These are going to be the same no matter what time of year or what our sales are. The next line down is going to show our variable expenses. You can also see, just like labor, that our variable expenses are also decreasing as sales decrease. This could be because our store isn't open as long, we're not using as much utilities, and so those variable expenses will also decrease. You may also want to put in your startup costs. So for some people, this is going to be a one-time massive payment. Maybe it's the very first month. For others, you may have taken a loan out or borrowed money in order to get your startup costs. So this particular payment might show up in your fixed expenses or in your variable expenses for month to month. Once you've subtracted all of your expenses from your revenues, you will end up with your EBIT, or your EBIT. This is your earnings before taxes and interest. This is going to give you a really good view as to how well your business is doing. Your EBIT is also referred to as operating profit. This figure is so important because it provides your business with a clear idea of your earning ability. It allows for any lending companies to look and make sure that you're generating enough revenue to keep your business operational and to keep your doors open. This one particular figure is going to sum up all of the research that you've done and all of the work that's going into keeping your business running. So this lets you know if your business can be successful. There's one other number that we need to figure out, and that is going to be our net income. So your net income is usually what most business owners are interested in seeing. This is the income that you actually get to keep or that you get to reinvest in your company. So net income is all of your sales revenue minus all of your costs, all of your expenses, all of your taxes, and this is the profit that is left over. You'll also hear this referred to as net profit. Now that you've learned every part of what goes into sales forecasting, and you've learned how to do effective research to get you to the information that you need to ensure whether or not your business is going to be profitable and successful, it's now your turn to look at your own numbers and put together your own sales forecast.